Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about the housing market in 2025 versus housing 2008. We'll also talk about new home sales and other things. First, I want to say thank you to our sponsor, Optimal Blue, for making this episode possible. Logan, welcome back to the podcast.
It is wonderful to be here. You know, it was Sunday night last night. I was doing my thing, and all of a sudden, I was getting a ton of messages as Zero Hedge, as we refer to them as Zero Brain Dead, sent a tweet out saying that 41% of all the loans, all the mortgages in America on the bank's books are ARMs now. Didn't give any more details to that, and they sometimes do creative tweets just to get attention, but that set off a firestorm because then everyone was like, we told you, or there's ARMs everywhere, housing 2008, everything. And then, of course, I just brought the data out and shut that down. Oddly enough, very poor timing for them and everyone on X who fell for it. The Federal Reserve actually just came out with a paper on August 7th about this, and where they highlighted that other countries have much higher housing stress than ours because they're tied to short-term debt products, where the U.S. is 90% plus 30-year fixed mortgages. So it's a much different marketplace. So we had to shoot that down. But I was thinking about, it's like the 3 years now, now that we're kind of in the peak period of the existing home sales inventory data, and we're going to go over the new home sales report after this. 3 years of the housing market crashing in 2005 to 2008, and 3 years of the housing market having the fastest crash in home sales ever in 2022, and just basically staying here. But you cannot have two different housing markets over the last 100 years. And one of the things I want to say is, when I die, I just want people to remember that we fought against the Russians, the Chinese, the Iranians, but also the zero hedges of the world, which is very prone to anti-central bank fanaticals out there. But here, it's done. It's history. It's in the books. And we could really show the difference now, because now we have 3 years of both. And it's glorifying to see how qualified mortgage really changed the landscape, not only just for the housing market in America, but for the United States of America's general economy too.
Okay, so wait, isn't there something you want on your tombstone? Something about
yes, it's when I die, you put Chart Daddy and then you put the foreclosure data on there. And we always say, Uncle Dave, right? Everyone says it's housing 2008, and then we have the real crazy people say it is worse than housing 2008. By the way, I saved everyone's tweets to me on that. There is going to be a day, oh Lord, there's going to be a crucible someday on this, and everyone who ever used my name on anything, I'm just going to smash everyone one day. But in any case, when that glorious day happens, what happened was the housing market, to go with Zero Hedges analysis, was very tilted toward ARM loans being part of the massive growth in credit back in the run-up from 2002 to 2005. You could see the ARM percentages were rising, except the real problem was the ARM percentages were going with exotic loan debt structures and guidelines being very poor. So the massive credit sales boom, which we've never been able to replicate for 14 years. This is why I always like to highlight the purchase application data. We never, ever had a massive credit sales boom, nor do I believe we can ever have one ever again with qualified mortgaging. But in this case, home sales were booming back then. But when the credit markets broke, if you do not have the ability to keep credit flowing, then the system breaks. And what happened was, in 2005, when home sales started to crash, it took 3 years to get down to the bottom. And then during that 3-year period, inventory escalated from 2.5 million to 4 million. But we were having foreclosures and bankruptcies rise in 2005, 6, 7, and 8. And in 2008 was the highest levels of monthly supply. And we had underwater mortgages, deteriorate, all these things. The exact opposite happened here, where you had total active inventory break to below 1 million on the NAR side during COVID. For us, it was down to 240,000 in March of 2022. But back then, which a lot of people don't remember, because you have lives and not a loser like I am, inventory and sales and prices were growing from 2000 to 2005. And we were at 2.5 million active inventory in 25, and then the vertical inventory data went off in 2006 and 7, and we peaked out. Completely different marketplaces, but now the 3-year home sales is over with, right? We had 3 years of sales there, 3 years of sales. They're both at very low levels. I would argue sales are historically even lower today than back then because of population growth and household formation and labor force. But the inventory data is much different, right? Here, we're at 1.55 million, which for me takes my low inventory conversation out of the. I mean, I was never a low inventory person up until we got to 2020, which took us to a whole brand new ballgame. But 1.52 to 1.93 was the 5-decade low in active inventory. It's good enough for me to get the low inventory conversation out. But we're at 1.55 million. Back then, it was 4 million. Back then, we had years of credit stress, foreclosures and bankruptcies. Here, we're not even back to pre-COVID levels. If you look 30-day delinquencies, you take the ICE data, we're still near record lows. The trick they do with FHA is that if you actually take FHA percentage of delinquencies and you string it out for the century, all of a sudden the data now doesn't look very abnormal, but they cut it off. These people always cut off the charts just to make their point. But in any case, the credit markets are so different. And now you can understand that prices never followed volume, as that crew always says. We didn't have the biggest home sale crash and home price crash in history like some of them had forecasted. By the way, some of you are off by 29 to 62%. I kept all your forecasts and I elongated it out to do a cumulative advantage, and I got your name and face in every single one of them. You're all toast. You're cooked for the rest of your lives. So the smart ones have realized never to talk to me again because I just keep on showing you that people figure that out now. But yeah, two different marketplaces. So what Zero Hedge tried to do last night is try to trick people by saying mortgages or 41% of all mortgages in America held by banks are ARMs, not giving any details that people go, oh my God, all these ARMs are out there and everything. It's just not the case.
So what is the real statistic there?
I mean, if you look at the purchase application data that actually tracks the ARMs, whenever rates go up, the ARM percentages do pick up, but they're like never above 10%, where in 2002 to 2005, that thing rose up, but the debt, the mortgage growth volumes are so low that on a, if you really want to use a per capita basis, it's really, really low now, the ARMS loans. So the accumulation of 14 years, again, reading is a good thing. There's actually no mathematical way to have 41% of all the mortgages in America to be ARMS, but they are a disenfranchised, fanatical cult group that has taken advantage of men, kind of like how Al Qaeda takes advantage of men who don't read to form them into terrorist groups. The Zero Hedge or Zero Brain Dead readers have been sucked into dealing with the Russian trolls in the last decade. I learned a lot, and there is a very, very dark correlation between the Russian trolls and the Zero Hedge readers. But in any case, even the craziest people in America were like, wait a second, that doesn't sound right. Like we don't even have that many like ARM loans that were growing for years. How do we get from like 5% to 41%? This is what this crew does. So, and the data just basically shows that a monthly supply back in 2008 was like 10.8 months, something like in that level. Monthly supply, like the last existing home sales report, is 4.6. So completely different marketplaces. Homeowners are doing good. They live in their house. They have sex. They have kids. They go to work. They come back from work. They go to sleep. They watch TV. They watch Love Island. They watch football. They act like normal human beings. They are not the fanatics on X or on Instagram, on YouTube, and all that stuff, right? This is why we've created this holy economic war against this group. And it was encouraging to see that even the craziest of the crazies were like, dude, this is completely wrong. There's nothing in the data. And that's just a function of the credit markets, right? The credit markets changed because qualified mortgage came in and all that changed. And I say this with short-term rates coming lower and long-term rates staying higher, you're probably going to get more ARM growth out here. But the ARMs, like you have to qualify for the recast payment and they're not even saving you as much as people think. But it's just such a different world, and that's because regulation changed the U.S. economy with the 2005 bankruptcy reform laws and the 2010. And now that we have 3 years of home sales from 2005 to 2008 and 2022 to 2025, everyone can visually see. Even if you couldn't read, your eyes, as long as you could visually see, all the data looks really different in that context of the credit side of the marketplace. And that's why we never had the escalation of inventory. And I mean, think about it this. Before home sales like even crashed, active inventory for the NAR was like 2.5 million. That's almost a million higher than where we are today before the sales crash even happened. So completely different marketplace. It's not fun and sexy to talk about boring economics the right way, but we try to do this in a way that's entertaining, but now visually could see, right? If you can just look at this, you go, wait a second, there's something, but you have to figure out why. Why is it so different? And it really is the regulations that were put in after 2005 and 2010 that paved the way for 14 years of data looking like this.
I think that's such a good point too. What you said, even if there were more arms, these are not the arms that led to 2008. These are not something that's like, I'll just slap this on you. You have to qualify for the higher rate, whatever that arm is going to adjust to, right?
I mean, that's one of the reasons why it's not really popular, nor it's going to be popular. It can be popular in the sense that if I qualify for a 6.5 mortgage rate on a 30-year fix, but I could get a 7-year arm at 5.625, and I could qualify for the recast, and your wages grow during that period of time, you could see arm growth in that as short-term rates come down. But it's just, we don't have that kind of credit boom. Like I always like to show the purchase application data going back to the 1990s. And we had a massive credit boom really from 2002 to 2005, but we've never been able to replicate, nor do I think we can ever replicate that ever again with qualified mortgage in place. So 2 different cycles, but now that we have 3 years in the books, it's over, right? For the next 100 years, all of these people who were 2008 and worse than 2008, their children, their grandchildren, all of them are going to go, dude, grandpa, you're crazy. Like, what are you doing? Why you embarrass us like this? So it's just the world works. It's so different than how it used to be 1,000 years ago when we just had simple scrolls to read and candles. Now you have TikTok and people dancing and doing charts and
and you are part of that. I don't know that you're on TikTok, but you do charts on the internet.
I know, but it's just you have to fight fire with fire, and unfortunately, the academic world, not most of them just can't. They don't have the luxury to be that free to do it. Oh, but this devil, this hellhound, he's ready to throw down 24/7. But we do it.
Especially, what are they thinking doing that on a Sunday night? They know you're watching. I mean, they should know you're watching. Maybe other people are going to let that go, but you on a Sunday night.
You know what though? Like, it is encouraging to see that even some of the crazy people are like, that just sounds really off. And then a lot of people are following up on that today. I mean, if you technically could put commercial loans in this and categorize it in a 3-month time frame, there are ways to manipulate data to get a headline, but they did what they wanted to. They are the ultimate doom porn out there. So, and their name is Zero Hedge, but we call them Zero Brain Dead. And if you look at the last 14, 15 years, a very fanatical, disenfranchised group just basically hates everything about America because they were born after when, Sarah Wheeler? They were born after 1913. And some people that are born after 1913 is just the hole, the black hole in their soul. Nothing you can do that could fill that void unless death, because living after the Federal Reserve was created was too much for them. They don't ever leave America. They don't take their Pirates of the Caribbean gold pieces and go on an island and become a libertarian, Mad Max. They sit here with their 30-year fixed mortgages and their nice single-family homes and nice cars, living a life and just crying about it every day. So you have your choice. You could be part of the devil's crew or you could be part of the light, right? And this is the conflict that has always happened since the Peloponnesian War.
I love it. Boy, if I had a bingo card right now for Loganisms, I would have so many on here. That would be good. But I think it's a great point to bring up because this is what the people in our industry have to battle all the time, because this, lots of people follow Zero Hedge. If it's not the people in our industry, it's their consumers. It's the people they're trying to sell a loan to or sell a house to. And those people are like, oh, this is a bad time to buy, or oh, the housing market's about to crash, which we know as a media company that for a long time, that was the biggest search engine, the biggest search question for our company was, will there be a housing market crash and then just put in whatever year it is. And that is like the most searched term. So we know that these kind of things have an effect on consumers.
To counteract fanatics in history, you get names, you get faces, you get 5 years of forecasts. And then you drag their carcasses out for the next 20 years. Because if you think intellectually you could go head to head with me, but knowing that my whole life, just getting up in the morning is to crush as many American bears as I possibly can. Cycles come and go, right? That's what models are for. They're designed to keep us in line. But this kind of goblins, this kind of things, oh, it's going to get Halloween soon. Oh my God. Sarah, AI Halloween, Logan's.
Oh
Lord, we're
gosh,
about to
I'm
go
scared
off.
already. I'm
In
already
any
scared.
case,
Okay, well, let me let's turn now to the new home sales, which we got that report today. Really would love to get your take because on the one hand it looks negative, on the other hand it beat expectations. So tell us what you think about
so
that.
the question is, have lower rates already helped the builders? Now this goes back to kind of what I talked about on CNBC, that the builder stocks are ripping, right? They're just ripping it up, and people just don't understand why that's the case when housing starts and permits are at recessions. This is a very complicated cycle, but if you look at new home sales out for like 10 years even, we're basically in a sale range from 2018 to 2025. You take the COVID burst and then the low levels of 2022 out of the equation. And what happens is when mortgage rates get towards 7% and higher, it's harder for the builders to sell homes. And then when they come towards 6%, it's easier for the builders to sell homes. Corporate profit margins are falling for the builders, right? So they have less leeway. Smaller builders don't have that advantage. But mortgage rates are heading down towards 6 again. And we don't ever break below the 2022 lows ever. So many months of positive revisions. In fact, the only reason we had a month-to-month decline is because they revised the last month's data higher. So again, it's just a story about, it's more about supply, right? And in the article, I show the shorter-term durations of total units. And to me, is it's like I felt so bad going back in the last decade. I never explained this clearly enough. I just assumed people knew that the monthly supply for the builders doesn't mean active units for sale. And looking the last few years, I just realized a lot of people see that 9.2 months of inventory. They think it's like millions of homes. And the easiest way to show this is if you go back many decades, it's rare for the builders to have more than 120,000 total completed units for sale. Right, those are the homes that are active and live, and they're now some of those houses are going to get sold in the next few weeks or months, but it doesn't typically go above that. And people think that's like a massive amount of inventory. Guys, 2 weeks of our new listings data, just 2 weeks, takes out the entire builder's completed units, really, for like 5 decades, because majority of inventory comes from the existing home sales because the majority of the stock is. So here we are, 9.2 months, but it's like 120,000, 121,000 homes. So I think when you break it down, it's like 2 months of supply. If you just look at that, if you look at like 4.9 months of supply are homes under construction, right? So they're not out there sitting, they're in a lot of those homes have a contracted buyer. You don't see very high cancellation rates for the builder. So they have product, they get rates a little bit lower, they could sell them. The problem for this now is that the builders don't usually typically issue single family permits, or housing starts don't really grow in this environment. So that's why I like to show the short and long terms, because completed units is the real thing. But if mortgage rates are 7.5% or 8%, we have a whole different story with the builders, right? You're not going to see that rally in builder stocks. But what typically happens, rates were going lower. This is somewhat similar to what happened at the end of 2022. But back then, there was a very high cancellation rates. New home sales were so low. Corporate profits were still good. So the builders can, when rates go lower, they can sell homes. So here we are again. Is this going to be the third time rates go down to 6% and the builders do well? Big publicly traded builders are telling you yes by their stock performance. And this is similar to what happened before. But again, if rates shoot back up, then we're back here again. This is why we can't get any traction going with housing starts. And we said this, you're not going to grow housing construction this decade unless rates fall, because the builders are simply, they just don't move fast enough. They don't put their heads down and build to pile up, units of sale and have their corporate profits. That's not how you run a business. So I'm hoping now, doing this for 2 years and showing those charts, that people could understand, but it was never the marketplace of millions of homes. They've never done that. The highest it ever got was like not even 200,000, slightly under 200,000 in 2008. That was it. And we had 4 million active listings back then. The builders never even got over 200,000. So different marketplace, different structure. And you could always sell, like, people have never read a new home sales report because they never read how the monthly supply is broken up. So they think, well, the builders have 9.2 months of monthly supply and the existing home sales market is a 4.6. But why are the builder stocks running up? They can sell these. If rates go lower, they can sell them, right? And they sell them, they make money, and kind of that's how they operate.
I think that's, to me, has always been the most valuable part of what you put in your coverage of this topic is when you break it up and you're like, yes, 9.2, but how many of those where the construction hasn't even started yet? And then how many of those are still like, we've got still quite a while before they're going to come to market. And I do think that's the missing piece that most people don't know.
Yeah, I mean, I really saw this post 2020 because when the builders had that big spike, you had people talk about like there's millions of homes. I was like, what the hell are you talking about? And then I realized, oh my God, they've never, ever read a new home sales report. Like they've never seen, they'll see a headline and Sarah, what do we say? Reading is a good thing. The history of human civilization has taught us those that read have a benefit over those that don't. But in this case, I think we've made a good enough progress to kind of teach this. And, now that the builder stocks have rallied so much and Warren Buffett has a big stake, we've saw this before in recent history. So I think there's a little bit better understanding. And I fully blame myself because this is not something that I really talked about much because I just assumed, and I assumed people read, and I've learned that they don't. And in the last decade, my thing was that we're going to have the weakest housing recovery ever in history. Like, I don't believe the builders are underbuilt. Like, this is where I divert from every person in economics. The builders only build off of the demand curve, and they had missed sales in 2013, 2014, 2015. I remember going on CNBC in 2015 and saying, listen, the builders stocks are way too high. They're not going to make these numbers. And in 2018, there was a monthly supply. So there was all these things in the last decade. You don't see that now because new home sales are at 2019 levels, right? That's a sub 6% mortgage market world. Their corporate profits can do better and they can feel more better when rates go lower. But if that was the existing home sales market, we have 1 million more home sales today, right? So that's the divergence between the new home sales market and existing. But yeah, the 9.2 monthly supply for people just like they see that and go, oh my God, that must be millions of homes. It's just not. There's over 147 million total housing units in America, right? So it's not, it's a small percentage of that. That's why the existing home sales market has the biggest bulk of inventory capacity.
It's why we don't talk about those two things. We don't get
Fight Club rules, baby. Fight Club rules, which is funny because Zero Hedge, Tyler Durden, they kind of take the theme of Fight Club, but everyone needs enemies. I think it just makes life more fun, right? Niners versus Cowboys, Lakers versus Celtics, but here it's good. It's good to fight the American Bears every day.
Yes, and all of these topics and much more you're going to be covering as our keynote economic speaker at the Mortgage Banking Summit that we're having here in Dallas in October. Cannot wait for that. We already have people being like, okay, what's it going to be? I think the title of your session right now is What the Bleep is Going On in the Housing Market. And really that covers between now and then. That's a perfect title.
I know. I mean, it's even though we picked up some of the changes in the housing market mid-June, we just got the tracker inventory. I got nothing. Active inventory was barely anything. And if I take it from the peak of where it was, we're going to have a decline. We only have one more week left. And then we have the holiday weeks, which screw up everything. But I don't think anyone had it in their bingo card that inventory could be negative in August with rates not near 6%. We're heading that way. And again, spreads again today. 10-year yield was up a few basis points. Mortgage pricing up just a smidge. The negative story of 2023 was the spreads, but the positive one in 2025 is the spreads. The tracker data it's getting really interesting that we might have a normal year. Like I always say, 2025 is my favorite year out of everything, because it resembles balance. It resembles something normal out there. And I love the fact that we had over 30% year over year growth in inventory, and we're not holding it up at this pace. If it continues, we're going to be in the teens, but it's still a positive year. we're something back to normal. And that's what you want. You want housing back to normal. You don't want the unhealthy housing market of 2020, the very unhealthy housing market of 2021, the savagely unhealthy market of early 2022. You get balance. And remember, this is going to be here for decades, very, very long time. You want stabilization in something like housing because it's the cost of shelter, something people need every single year.
Logan, we are out of time again. Thank you so much for being on. Thanks for that special Saturday edition. I thought that was a great podcast. We heard from a ton of people who were so happy to have that this weekend to try to figure out what was going on with rates. So thanks for always being our analyst and so timely on the spot.
Pleasure as always, Wheeler.